Global financial markets reacted to a series of important economic releases from North America and Europe, offering fresh insight into trade dynamics, labor market strength, inflation trends, and overall economic momentum. Canada. Trade deficit widens, KD faces mild pressure. Canada released its latest trade data for November, showing a widening trade deficit that exceeded market expectations. Exports declined to 63.94 billion Canadian dollars, while imports rose to 66.14 billion, resulting in a merchandise trade deficit of 2.2 billion Canadian dollars. The figures suggest that while domestic demand in Canada remains relatively resilient, external demand has softened. This imbalance places moderate pressure on the Canadian dollar, although its overall direction remains closely tied to energy prices. As long as oil markets remain supported, downside risks for the Canadian dollar may stay limited, though upside momentum appears capped in the near term. United States labor market remains resilient. In the United States, labor market data continued to confirm economic resilience. Initial jobless claims rose slightly to 209,000 but remained near historically low levels. Continuing claims declined modestly, reinforcing the view that layoffs remain contained and hiring conditions stable. This data supports the Federal Reserve's cautious policy stance, indicating that there is no immediate need for aggressive interest rate cuts. As a result, the U.S. dollar remained well supported, particularly against lower-yielding currencies. U.S. trade balance. Structural deficit persists. The U.S. trade balance for November showed a larger-than-expected deficit. The goods and services trade deficit widened to $56.8 billion, while the goods trade deficit expanded to $86.9 billion. While trade deficits are generally negative for a currency over the long term, the market reaction remained muted. Strong domestic demand continues to drive imports higher, offsetting concerns in the short term and keeping the dollar relatively stable. Productivity and labor costs send positive inflation signal. One of the most market-relevant releases came from U.S. productivity data. Non-farm productivity rose by 4.9%, while unit labor costs declined by 1.9%. This combination is viewed as highly favorable for the inflation outlook. Rising productivity alongside falling labor costs reduces inflationary pressure without damaging growth, supporting the Federal Reserve's soft landing narrative. These figures reinforce expectations that interest rates may remain elevated for longer, but without the need for further tightening. Eurozone. ECB maintains data-dependent stance. In Europe, comments from European Central Bank officials reinforced a cautious and data-driven approach to monetary policy. While inflation has shown signs of easing, policymakers emphasized that risks remain and that any future rate decisions will depend on incoming economic data. The euro remained range-bound, with price action driven largely by movements in the U.S. dollar rather than euro-specific strength. U.S. growth indicators show stabilization. Additional U.S. data provided encouraging signs for economic activity. Factory orders rose by 2.7%, indicating a rebound in manufacturing demand. Wholesale inventories increased by 0.2%, suggesting confidence among businesses in future consumption trends. These indicators supported U.S. equity markets and reinforced broader optimism that economic growth can remain steady without triggering renewed inflation. Energy markets. Natural gas remains volatile. In energy markets, attention remained on U.S. natural gas storage data. Ongoing uncertainty around weather patterns and seasonal demand continues to drive volatility, making natural gas prices particularly sensitive to short-term supply and demand shifts. Market outlook overall. Markets are transitioning from a phase dominated by inflation concerns to one focused on growth sustainability. The US dollar remains supported by strong labor conditions and improving productivity, while the Canadian dollar faces mild pressure from trade data. The euro continues to trade within established ranges, awaiting clearer signals from the ECB. Gold and commodities remain sensitive to movements in U.S. yields and the dollar, while equity markets benefit from signs of economic resilience. Market participants remain cautious but constructive, closely monitoring upcoming data releases for confirmation of current trends. USD, stable to bullish on labor strength and productivity. Gains, CAD, mildly pressured by trade deficit, oil remains. EUR, range-bound awaiting clearer ECB direction. Gold, sensitive to yields and USD strength equities, supported by growth data and soft landing optimism. Overall theme markets are transitioning from inflation fear to growth sustainability. Volatility remains elevated, but risk sentiment is cautiously constructive. Closing, 9:30, 10 WEG. That's all for today's market outlook. If you found this breakdown helpful, stay tuned for our next update. Trade safely, manage your risk, and thank you for watching.